Good morning. 9/18/2012. Bull rally in the S&P continued up to our target of 1475. When we were back over here, breaking that high over here, this weekly high here, is that we said that the S&P from its highs, that meaning at 1435, that we could travel up to 1475 on the S&P. And we hit 1475 on the S&P. Now, just to correct everyone out there in the world, is that it was either going to go 35 handles higher to the 1475, or we were going to have a pullback, and like every bull rally has. Well, now that we've hit our target 1475, and that was a target we actually had a couple of years ago in the mess of all of this. Politically, we had QE3 by Mr. Bernanke. They went way and beyond. Open checkbook to print money. That's what got us to 1475 on the S&P. Now that we are reaching the upper end of the target of 1475 with a reversal at that 1475 area, we would be looking for the S&P to come back down to right around from 1475, a good correction within the S&P before you could get a Christmas rally, depending on what the elections are going to do, is that the S&P would travel from 1475, would come back down to that 1395 handle. Or better yet, it would come, and the reason why I say that is that the 10-week moving average has been rising during this bull trend, but let me tell you, that 10-week moving average is at 1414. Now, like within any bull rally, that once you hit the top end of that S&P target, which it has not seen for a number of years, and we're right up at multi-year highs of where the financial crisis started, we hit our target. We do have another target on the S&P if they want to keep this thing going. 1525 in the shorter term frame would be that next. You got to break above 1499, and then you have to get up to that 1522 handle on that S&P. Now, when I say that there will be a correction, every bull rally does have one from where we actually end up making that top move. So what I would like to share with my MMTs is that when we take a look at this area of the market, this is where it started. This is that 2-week parabolic breakout right up to the major resistance level. Now, a lot of people have underperformed the market. They're going to try to play catch up. That is one of the catalysts that could keep it going higher, is because people have sat out on the sideline. Mutual fund managers are underperforming. Hedge fund managers, 11% are performing out of 100. There's a big disconnect there on the performance level. Chasing performance is what can run these things up higher. Now, before we can ever get back up here to these areas of resistance level that I'm talking about, is you got to have great pullbacks in order to get there. So far, when the FOMC meeting did their thing, people did start chasing performance, because he basically told you you're not going to get a return anywhere else unless you buy equities. And keeping low rates out to the middle of 2015 would certainly accommodate that in various different sectors of the broader tape. However, once again, bulls have to have pullbacks. They always do. And we always tell people when that's going to happen. Right now, we're in a little bit different environment on the calendar year. We told everyone here that we were shorting that pullback, and we got long. And how far they were going to take it when they broke that resistance level was yet to be determined. We've had massive worldwide stimuluses. We've had every kind of accommodative easing that you could want. We've had a high frequency buy and sell script. We are overbought, and you can stay overbought. There is a lot of what would I call it? What would be a better way of people understanding it? A lot of people are not really involved in the move. So all of that money that's on that sideline, when these dips do pull back in this bull structure, how can you get to 1525, 1550 on the S&P by year end? Depending on what happens in the election, and there'll be some other factors. Who knows if Europe is going to continue to do the right thing or not. What does matter, though, that It's been a long, 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 long multi-year bear trend in the S&P. Started in 2000, started twice, came back, tested all the way down here from the lows. So when you take a look at the expansion of the S&P, you got to go back over to 2009. We were buying those lows, that there would be a tsunami rally. Now, in every expansion, whether it's an economic growth expansion, which we do not have, and or what we do have is the second phase is a stimulus expansion. The whole 2009 deal has been a stimulus expansion. Yes, we've had pockets of growth here and there, but we do not have growth and low unemployment as one should say that a bull rally would be sustainable, because you're going to need the home builders. They're trying to put in the lows. That's going to be a catalyst to the S&P. Some of them trading there. The financials are going to have to pave the way. Same thing that took it down in the financial crises. It was those sectors that lead it down. And internet and tech has played their role to this point. We're going to be going into a major earnings reporting season again, and that's going to be October 8th of 2012, less than a month away. We'll be full into it. So basically, we've got the yearly expansions in 2009. When we short these highs here, they run. Every bull like this, every bull cycle has got to have a pullback cycle. We will have a pullback cycle up here. The difference between this pullback, unlike others, if everything continues to go well and you got that quantitative easing in there, is that people that have not performed the market, they basically, the Federal Reserve basically have told the bigger dollar money people, you will buy equities. Period. Now, look, everything has a system to it. Everything has a consequence to it. And bull rallies do not perform parabolically only. When we had the great burn right here in the beginning of the calendar 2012, we shorted the whole move. We got the live videos and did it, and it was time to get out. That was the end of it. And it started in a weekly, and we called for a summer rally. How far that summer rally would go would have to be validated at the various different resistance levels. It's been on low on balance volume across the board. We're getting top end heavy. Now we will look for some price volatility. What we like to see from the very top of 1475, we'd like to see about a 7% pullback to create buying opportunities, like over here. This created the buying opportunity. We took out the calendar year high when we got right above this resistance level that I'm showing here. 1 week, 2 weeks, this is the third week above it. Now, I will caution people who are innocent to the market is that a lot of people will chase performances up at the highs like they always have and always do. Always will. I will tell people right now to be quite leery of the fact that there could be a pullback around the corner now that we've hit that 1475 area. So we benchmark our target of 1475 and the percent level retracement from that level, and coming down here and hitting this blue line at the 10-week would be healthy for the market. It would be. And or undercutting it and coming back down here to the 20-week would even be better. Because you're going to have the money on the sideline that on the dips, they're going to want to chase this rally. They're going to be looking for a point of entry. We will keep you updated. Today is Tuesday. We had Monday up and Tuesday up. There's only 2 days in this weekly bar right up here from hitting our target. We'll continue to monitor our bigger traders that trade in the S&P 500 as far as their call side and the put side, so that they can balance and start getting below the market for that pullback, and they can continue to let the bigger part of the gain in the calls on the S&P continue to hold their value, but they need to hedge that. So if we get a pullback and they lose value in the calls, at least they're making some revenue on the pullback. Bull run, calendar year highs, resistance, price targets hit at 1475. How could it break it and go to the 14.99 area right below 1500 is that last group of people who would have to chase performance, because those people cannot keep money on the sideline. And sometimes being in cash for them is just as painful as a market correction. We all know that. So once again, we've gotten this far in the month of September. When we did QE2 back at the end of April of 2010, we had a 25% rally right through the worst month of September and October, right through November, December, January, February, right up until the highs where we shorted it in calendar March of 2011. And we had a 25% move. I do not see QE3 providing that same move that QE2 did. No, I do not. I do and will tell people that bull rally will have to have its behavior as every bull does. Bulls are famous for shaking people out and then setting up and making higher highs. That's what true bull rallies are about. Once again, we will tell people that you can go higher in the S&P only because people would be chasing the last part of the high. It is possible to break our 1475 to 1499. But at some point, whenever that day comes, we will have that correction. Had we not gotten QE3 and all of that stuff that the Federal Reserve just did, which eventually could actually end up hurting our economic growth, believe it or not, is that we would have probably already had that pullback and be in that process. But when QE3 came into play, that took that off of the table. And you constantly have to make adjustments to the marketplace. And you let these things continue to travel to where they get to overbought levels where they have to correct. And will correct. So we would tell people to be very apprehensive up here at these levels. People will try to chase performance on pullbacks. We're going into the calendar earnings. That's not for a few more weeks. Here we are. There's our target. We broke above here. We said when we were at 1430 we could see 1475 before we would see 1395. And that's exactly the way that the bull had gone up to test those levels. And they're multi-year levels. I mean, when you take a look at the scheme of it all, you go back to year 2000, 1522 right up here. I was short that. Double top. We were short this in 2007. There's a long ways that this S&P could get up to. But remember, you got to have corrections before you make higher highs. And when we take a look at the broader scheme of it, we are looking at this this trend line here, 1474.95, a break up there right below the 14, be about 14.99, right below 1500, and that's going to bring you right back where the financial crisis started, and that the expansion, stimulus expansion, I did not say economic expansion, I said stimulus, and it's been a multi-calendar year. We're well into the tooth of this. So you go from 2009, we're over, we're going to get close to, a point where even stimulus will really weaken up because it'll all be in the tape. So it's going to be a very interesting fall that starts this next Saturday. And it's a major update. And we just will let people know that we will be trading these index options on the S&P 500. And we can clearly see that the S&P 500, I'll show you, here's that 1450 put. They got this thing clear down to $2.40. 13,000 contracts traded. Now, when I go out to October, or a weekly September, we can go out to September 28th, is we would take a look at where the S&P, right here, this is going to be a weekly when they write them, they're 20 by 22.90, they're not trading much. Here's that 1450, and it's a weekly at 720 by 890, 1,600 contracts traded. People have been fighting this bull move and buying extreme put options all the way up in the thing. Well, let me tell you, there is a big fat trade in here. When we get a clear indication that we could go up and test that 1475 again. We're going to be looking at making some serious money here. So when the S&P does pull back in any normal bull rally, that we're collecting some profits here.